All right. Hi, guys. Last week, in one of our online communities of over 150,000 people, we put out the question of who people would want to see speak on the current macroeconomic climate. We had tons of responses, and one of the most highly frequented responses was George Gammon. He's a libertarian, a climb micro addict, who has a focus on real estate. He has nearly 100,000 subscribers on YouTube and is a pioneer, or at least a very big pillar in this area. Maybe not a pioneer, but in any regard, happy to have you and honored to be chatting with you here, George.
Hey, buddy, I appreciate you having me on the show. Totally excited to dive right in.
Perfect. So what I understand right now, just to get the full zoomed out macro view at the start here, is this is the quickest and the hardest that our economy has ever really been hit, comparing it to 2008 or other times of recession or depression. Do you feel like what's happening has been already destined to happen, or was this exclusively from coronavirus, or were there factors already at play that, were already going to start to influence this?
I think the coronavirus was just the pin.
Mm-hmm.
The Fed has been blowing these bubbles since the late 80s. You can take it all the way back to Greenspan. And every time that we had an issue, let's go to the dot-com bubble, the way they quote unquote solved the problem was to artificially lower interest rates, just trying to create another asset bubble somewhere. And so we went to a housing bubble. Then in 2008, what do we do now? We've got to inflate some sort of bubble, because our economy, unfortunately, is based on three things. It's asset bubbles, debt, and confidence. So what they did is they inflated the everything bubble. So when you've got the everything bubble, you've got consumer debt at all-time highs, state debt all-time highs, sovereign debt, corporate debt, all-time highs. You can't blame the coronavirus for your underlying problems. Granted, it's the pin, but it goes a lot deeper than that. That's why a lot of people that I go back and forth with on Twitter, social media, on the comments of my YouTube channel will say, well, if we just get by this and we get herd immunity, or maybe we get the R0 value down to a specific level, it's not going to be a big deal. April, we go right back to where we were, and the economy is quote unquote back to normal, right? And I say, well, if normal, you mean an economy that cannot stand interest rates above 2% and has to have the Fed's balance sheet at 4.5 trillion and going up, not down, well then, yeah, I guess we can get back to normal. But I would not call that a healthy economy, although it may be normal compared to where we've been the last 10 years. So.
Yeah, and there's been a lot of people, because generally these cycles happen every 8 to 10 years. So people have been calling for the inevitable correction for multiple years now. And it just feels like the writing has been on the wall for a very long time, especially in regards to these 3 points that you're mentioning. What did you feel that it was their game plan? Were they just waiting for a pin to kind of use as a scapegoat? Or what do you feel is like the Fed's game plan? Do they just continue to let assets appreciate indefinitely? Because, as appreciation happens, like as the bubble happens, inevitably comes the pop as well.
I don't think they have a game plan. I think they're 100% reactionary, and they're going to try to say that they have a game plan and that everything's fine. Why? Because the economy, one of the pillars is confidence. So they have to pretend that everything is a-okay. But behind the scenes, they don't know what's going on. And let me give you an example of that. I did a video the other day where I talked about the Fed funds rate. And this is the interest rate for your viewers or listeners who might not know what that is. When the Fed comes out and says that they're lowering interest rates from, call it 1% to 0 or whatever, that they're talking about the Fed funds rate. So that's what you hear on CNBC, on your local news, or when Jerome Powell comes out of a meeting and say they're lowering or raising interest rates, they're talking about that rate specifically, okay? So the Fed is supposed to have total control. That's the shortest possible point of the yield curve. They're supposed to own that and be able to micromanage it, okay? Well, most people don't realize that first of all, the Fed funds rate is, it's not a specific number. it's a range. So right now, although we're at 0% interest rates, technically it's a range between 0 and 25 basis points, and it can fluctuate through the entire range. So if you go to the Fed's website, they say, you know, the Fed funds transactions that happened yesterday, let's say they were at 10 basis points. Well, what they don't tell you is that not all the transactions were at 10 basis points, and probably very few of them. And to make it a little easier to understand, let's say our window is between 1% and 2%, right? Well, some of the transactions could have happened at 0. Some of the transactions could have happened at 5. You don't know unless you pull back the curtain and look at every single individual transaction. True, the average, the sum total, or the average of the total of all the transactions for the day equaled, let's say, 1.5%. So it was in their range, but it could be wildly up and down all over the place. So that's an example of the Fed really not having total control over that. But the way it looks to the public is that, oh, wow, nothing to worry about here. I'm just going to go out to the movies. I'm just going to go further into debt. I'm just going to spend more money on my credit card. I'm going to do whatever, because the Fed wants me to go spend money, because we need to get the demand up, because they're all Keynesian economists. And the more money I spend and the less money I save, the better it is for the economy. And I'm doing my job as an American.
Definitely. So for some people who maybe aren't, because like I think you alluded to it very well, how exactly does that rate affect someone in their everyday lives? Just to like really focus in if someone's still new to this concept.
That's a whole podcast in and of itself right there.
Right.
Technically, the way it's supposed to work is when the Fed lowers the Fed funds rate, it's the effective Fed funds rate, it's supposed to bring down the entire yield curve. Usually that's what happens. And if the entire, and when I'm talking about the yield curve, I'm talking about the 3-month T-bill, the 10-year treasury, the 30-month treasury. So I'm talking about government debt specifically. Right. So if government debt comes down, as far as the interest rates, that means the prices are going up. Technically, that's supposed to bring down all other interest rates throughout the economy, meaning mortgages, credit cards, auto loans, student debt, those types of things. So the Fed is trying to, again, their words, not mine, stimulate the economy by bringing interest rates down, so people are more incentivized to go out and to get deeper into debt and spend more money. And they see it exclusively as one man's spending is another man's income. So the further in debt we can go due to spending, technically the better it is for the economy. So when they're lowering that rate, they're going to try to lower the entire yield curve. That supposedly doesn't really work this way in practice, but it brings down all the other interest rates, boosts spending, therefore boosts the economy. That's the way it's supposed to work in a textbook, or their textbook, not mine.
Right. And so what have you seen has been the actual tangible impact of their actions now? Because obviously everything's in theory. It doesn't always work in practice. So what are you seeing out there in the world in terms of tangible impact?
Well, something I'd point to directly that just goes to further prove the Fed is totally out of control. And they're just throwing anything up against a wall to see what sticks, really, and praying and just, well, hopefully this works. But as an example of that, if you look at a chart of quantitative easing, so I'm not talking about this last just QE infinity, I'm talking about quantitative easing 1, 2, and 3. The purpose of quantitative easing is to bring down the yield curve, so bring down those interest rates to increase demand for borrowing. Okay, well, you got to look at a chart of the 10-year treasury, so the interest rate on the 10-year. So when the Fed is doing quantitative easing, the process there is they're printing money. They're creating currency units out of thin air. Those are bank reserves. So they're technically not in the system yet. It gets very complex, but you've got to look at bank reserves as a separate kind of dollar, compared to dollars that are actually in the retail banking system circulating throughout the economy and potentially creating inflation. Those are two completely separate things. So, but what basically happens with QE is they'll create bank reserves and they'll buy assets. So they'll buy treasuries in the real economy or from the primary dealers, whomever. So that's creating additional demand for, let's say, those 10-year treasuries. Okay, well, if there's more demand for 10-year treasuries, the price of those treasuries should go up, meaning the interest rate should go down. That's the whole point of QE, or one of them. And so if you look at a chart, what happens every time they did it, not just once, but every time, QE 1, 2, and 3, interest rates on the 10-year treasury actually went up, not down. So what's happening there is that, yes, the Fed is creating more demand for those treasuries, which should bring the yield down, but the market is bigger than the Fed. So the Fed creates, let's say, this much demand, but the market sells a lot more than they're buying. Why does the market sell? Because they see the Fed's balance sheet increasing. That gives us inflation expectations. And the market's going to sell those treasuries because they don't want to be holding the bag. Right. If you're holding on to basically dollars for the next 10 years, you're only getting paid 2%, and inflation is running at, call it 5%. So you've got a negative 3% yield per year. That's compounded. So you're losing a lot of purchasing power. So no one wants to hold the bag on that. So my point, you see my point. Definitely. It just goes back to the Fed funds rate, the 10-year. And what's interesting now is the Fed's balance sheet is just going parabolic. Yeah. If you look at a chart, I mean, it's shocking. It was at 4.5. I think it's probably at least up to 5.5 now. I mean, it's going up by like $1 trillion per week. They were doing 125 billion of QE per day. They're literally going to run out of things to buy, and they have to buy something in order to create those additional currency units. But so my point is, if they did QE 1, 2, and 3, expanded their balance sheet by, call it 500 billion, and interest rates on the 10-year went up as a result, well, how much pressure is that going to put on interest rates if the Fed's taking their balance sheet to 10 trillion or 20 trillion over the next, call it 4, 5, 6, 7 months, whatever? It's going to put massive pressure. So this creates a situation, I call it a doom vortex. And I kind of took a cue off of Real Vision. Raoul Paul started calling it a doom loop, I think. I thought, oh, that's fantastic. I got to do something. I came up with a doom vortex. But what it is basically, it's just something that it's a self-perpetuating cycle, in the sense that the Fed has to print more money to buy assets to bring them onto their balance sheet, keep interest rates low. At the same time, the market is trying to drive those interest rates higher. So the more the market's trying to drive the interest rates higher, the more money the Fed has to print to buy those bonds to keep interest rates low. The more they do that, the more the market wants to push them up, you see?
Definitely. So this is potentially going to be a large question, and everything is in theory and nothing is perfect. But, so as a libertarian, it's very a different mindset than, let's get the Fed pumping a bunch of money into this thing and government control. Yeah, right. What do you see? And obviously not as a perfect solution, because I don't think that exists, but as a more ideal scenario, and maybe it doesn't have to be on the full side spectrum of libertarian, but when you look at this and you'd say, listen, if you guys just made X, Y, and Z changes, we could be in a lot better of a situation.
You're not going to go into a lot better situation in the short term. Unfortunately, that ship has sailed. So you've got two options. Either you go through a lot of pain right now, meaning the next year or two, or you go through more pain than you can even comprehend in the short term. So this is kind of the cost benefit analysis that we as a society need to do, but unfortunately it's really not up to us. So the benefit to taking the extreme pain, and I mean unemployment at 30, 35%, I mean something that would look worse than the Great Depression for the next year or two. It wouldn't extend for 10 or 12 years, but it would be like nothing we've ever seen before. The benefit to that is when you come out the other end, the economy is much stronger.
Right.
You get all the malinvestment, all the bad debt, all of that gets flushed out of the system. All the bad actors, such as these CEOs who just levered up to the hilt and took all their cash flow, instead of saving it and putting it in the bank, they just spent it on doing buybacks just to pad their own pocket, whatever. So instead of doing that, you've got those people that are now bust.
Mm-hmm.
The assets are still there. The airlines still, the airplanes are still there. The manufacturing, the companies are still there. It's just the bad actors are gone, and they're replaced with people who are prudent enough to have the capital to buy XYZ business during the downturn. So it's the way the free market flushes out all the bad and brings in the good. And that's why when you go off to the next phase, then the economy is much stronger. Unfortunately, I think what's going to happen is the Fed is going to try to just print as much money as it's going to be the 2008 playbook on steroids. And they're going to try to get as much of the private sector balance sheet onto their balance sheet as they can. Why? Because if an equity or a bond takes a 50% haircut, they'd rather have that on the Fed's balance sheet because the Fed doesn't have a profit and loss. So let's just say our entire bond market is on the Fed's balance sheet. Well, there's never a seller because the Fed's never going to sell. So bond prices will never drop. Interest rates will never go up, right? So you say, well, that sounds great, George. Why don't we just do that? The problem there is the release valve is the dollar. And if they do that, the dollar, I think the dollar could be strong against other currencies in that situation. But if you compare the dollar to prices of apples at your local grocery store, the dollar is going to get crushed in that type of situation. There is no free lunch. That's the bottom line.
Yeah, and it's been very interesting because as this has, QE infinity has been announced, and even before that, the US dollar started gaining a lot of momentum and strength against a lot of other global currencies.
Right.
And to me, this is a little bit surprising. I don't have necessarily the depth to understand, what's going on, but I'm a simple man, print more, value less. So why is it valued more when they're printing more?
Let's see, what's the easiest way? It's so much easier with a whiteboard.
You got a wall behind you, just get the Sharpie.
Okay, so what you have to realize is there's two completely separate markets for dollars. Let's just try to visualize that. So we've got a domestic market here inside the United States. So you've got X amount of currency units chasing Y amount of goods and services. Outside of the United States, you've got a completely separate market for dollars. Just because we print dollars in the United States, it doesn't necessarily mean they get outside of the United States. They could stay within our economy.
Right.
And outside the United States, going back to 2011, 2012, the dollar was very cheap. It was about 70 on the DXY. And plus, we were doing ZIRP, 0% interest rate policy. So all of these countries and corporations outside the United States could just load up on dollar-denominated debt, and they could get it a lot cheaper than their own debt. Because if you're a Colombia, let's say, and you need to borrow $1 billion US, right? Well, you could do that in your own currency and be charged a 12% interest rate, because the investor would have to take on the currency risk. Or you could get a dollar loan and maybe pay a 5% interest rate.
Mm-hmm.
So they chose to go the dollar route. The problem with that now is that the dollar is much more expensive. So it takes a lot more of their currency units in order to buy the dollars to repay the debt. And if you're not an oil producing country, how do you get dollars to pay off your dollar denominated loan, right? You can maybe tourism, right. Hopefully you've got some exports, but you're pretty much screwed right now. And the only way that you can come up with the dollars to pay back the loans is to print more of your currency units to buy dollars in the open market, which creates more supply of your currency, more demand for the dollar. The dollar goes up on the DXY, right? So that's the first thing. You've got to understand the demand component outside of the United States, first and foremost. Then we go back to the United States, and the way dollars usually get out of the country is through our importing. So we run a trade deficit, meaning we import more than we export. Okay, well, if we're importing goods from XYZ country, that means we're exporting dollars, little green pieces of paper, out of the United States. Well, those dollars are what's used to collect by the other countries and the central banks to pay back these loans. So if we go through a situation where the global supply chains are disrupted, okay, and on top of that, we go into more of a deglobalization type thing, a more protectionism. In the United States, as an example, you can imagine politicians, when the coronavirus is in the rearview mirror, saying, okay, from now on, no more face masks being produced in China, no more ventilators, no more food, no more this. We want to produce everything right here in the United States, so we are never reliant on another country like we were before this happened. Let's learn from our mistakes. And I think that will be universal, left, right, you name it. Okay, well, let's think that through. If we're not bringing those imported goods into the United States, our dollars that we're printing aren't going to get out of the United States. All right. So then you have this situation where you've got localized inflation for goods and services, like the food you buy at the grocery store, your rent, your health insurance, while at the same time, there's a lot more demand outside of the United States for those dollars because they're not getting out. There's so much of that dollar denominated debt. So you get this weird situation where you've got almost like a stagflationary type of environment in the US, but outside the United States. Every single time you turn on CNBC, they're talking about how the dollar is so strong. And you're going, dollar strong? What do you mean by that? The last time I went to the store, my grocery bill was 15% higher than it was the week prior, right? So I'm not saying that we're for sure going to have stagflation. There are no certainties. There are only probabilities. The only reason I'm describing that is so hopefully your viewers can understand why the Fed creating more base money or bank reserves in the United States doesn't necessarily mean that the dollar gets weaker.
Gotcha. And so stagflation is a term that you use quite frequently, here, and then also I've seen you throw it around on Twitter. Can you just kind of give us the definition, kind of like point and parcel for
Sure.
stagflation?
Yeah, it's just where you have high unemployment and high inflation at the same time. And generally your economy isn't growing in real terms. You look at the 1970s is the best example of that. So what would that look like? Let's say our economy was growing at 4%, when this is in the rearview mirror, but we've got 12% unemployment and we've got, call it 5% inflation. So remember, it's not about nominal GDP, or else Venezuela would have the best economy on the whole planet
Right.
Earth. It's about real GDP. So you've got to take nominal GDP and subtract inflation. So if you subtract that inflation number and we're flat for real GDP, or maybe even negative 1%, then you're in this weird environment that although we have inflation, you have negative real GDP growth, high unemployment, and that's where they've got something called the misery index. And that's where your misery index gets extremely high. So that's what I'm talking about as far as stagflation. The stuff you buy on a day-to-day basis going up in price with high unemployment.
Gotcha. Makes sense. That's a good explanation. So pivoting back just quickly to the Fed and what they're doing, you presented a couple examples. I think as a libertarian, kind of it's almost like the flag or the theme song is "End the Fed" as a libertarian.
Yeah.
So what are you going to say? End the Fed. What are the alternatives that we have?
Well, just hard money.
Right.
So you go back to 1870 to 1913. That's the span of time that I always use. And I get it. You're not on a pure gold standard, but that's when we had, I think, the least ability to create additional currency units just kind of willy-nilly.
Yeah.
So now that said, I don't think you necessarily need to back it by gold. If you back a currency by anything that would restrict the powers that be, that would restrict their ability to create limitless base money,
Hmm.
That's what you want to do. So maybe that's a Bitcoin standard. Maybe it's a oil standard. I don't know. Whatever it is, you just got to limit the supply of the government and the central bank. I mean, I'd eliminate them, but just have a limited currency supply. Have it grow maybe by just 1% per year, regardless
Right.
of what happens. And so what would that do? Why is that good? The reason that's good long term is because the economy, as long as you got a free market economy, not that we have one now, but that's a whole nother video. But
Yeah.
assuming that you've got as free a market as possible, something like what we had maybe in the 80s or Singapore, something like that, then the natural progression for that type of economy is going to be deflationary. Why? Because every single day, the entrepreneurs that are out there with their small, mid-sized business or even large businesses, they're trying to figure out how they can produce a better product at a cheaper price. And they're
Hmm.
all competing against one another. So you just look at a cell phone or any electronics is a great example of that. So you naturally have prices in the real economy continue to go down. And it's not a bad thing. We with the Keynesians and the talking heads on CNBC, they like to paint deflation as this as a doom vortex, right? But if you think about it, it's really not. It's just the reason it's kind of bad now is because our economy is completely built on debt. But if we flush that debt out of the system and we've let the free economy or the free market work, then you get this kind of maybe a 2 or 3% deflation per year, which is what we had in the 1870s. If you go back and look at the 1800s, from 1800 to 1900, prices of goods and services went down by 50%. 50. I mean, think about what that would do for savers, right? So, and to take it a step further, if we look at the numbers from 1870, 1880s, right in there, we had about 3% deflation per year, but we had nominal GDP growth. We were
Hmm.
plus 1 or 2% per year. You had 4% interest rates, and you had wages, not just real wages, but nominal wages going up during that same period of time. So in some of my videos, just kind of make it easy for people to get their head around why this is a good thing, I use the example of a typical or just a McDonald's worker. I don't know if it's typical or not, but assuming that they're making $1,500 US take-home pay every single month, and let's just say we had the same numbers as the 1870s, 1880s, right around there. So if they're making $1,500 a month, let's say at the beginning they're living paycheck to paycheck, so their expenses are also $1,500 a month. Okay, well, if they stayed at the same job, they didn't move up the ladder, they just were there doing whatever they're doing, and they were doing the exact same job, well, their pay would go up by about 1% per year. So at the end of those 20 years, they'd be making $1,800 roughly per month take home. And you may say, well, George, that's terrible. My goodness, no one can live on that. You can't raise a family on that wage. But you got to look at the expenses side. Remember, their expenses were $1,500. Now their expenses go down to $800. So that same McDonald's worker is pocketing $1,000 a month, which, by the way, buys more goods and services,
Hmm.
when 20 years prior that they were living paycheck to paycheck. Nothing has changed except for their standard of living has improved dramatically. The takeaway is that if we want to improve the standard of living for the 99%, we need deflation. If we want to improve the standard of living for the 1%, then you need inflation.
Gotcha. I think deflation by many is painted as it seems like, once you have deflation, then we all turn into dragons and sit on our pot of gold and just wait for time to make it more valuable. But in your opinion, that's not the case whatsoever.
No, deflation would solve, I mean, it's not just financial problems. It would, I mean, you'd have, there's a lot of moral hazard with inflation, as an example, because if you're the average Joe that's out there, you can't save money. If you save money,
Yeah.
you're losing purchasing power. So the only way for you to get ahead above and beyond just you putting in your 9 to 5, 40 hours a week and just grinding it out and doing the best you can to get a raise, the only thing you can do is put money into your 401k, or it's to lever up and to buy a house. So because then you're, at the end of the 20 or 30 years when the loan's paid off, now you've got this equity. Now you've got your little nest egg, so to speak, right? Well, what that person's doing, if you think about it, is they're taking and they're saving money to put into risk assets. And the Fed has blown those assets up into giant bubbles.
Right.
So you're forcing the average American to take their savings, their hard-earned savings that they're going to need in the future, and to go further out the risk curve because interest rates are so low, and put them into these assets that are massive bubbles. Okay, that's inflation. If we had deflation, then you've got the same average Joe who could get 4% nominal from a treasury, let's say, or even a savings account. I mean,
Yeah.
you're too young to remember those days, but you could get 4% on a savings account. But remember, you've got 3% deflation per year. So in real terms, your money is growing, just your savings, just having it in a savings account, that you're taking no risk, none. It's not in a giant housing bubble. It's not in a stock market bubble. It's not in a corporate bond bubble. It's just sitting in your bank account, making 7% per year compounded. So in deflation, people don't go further out the risk curve. They reel it back in and take almost zero risk, right? That's just another huge fringe benefit on top of just a laundry list of things. And it even gets into social consequences as well. I'm under the opinion that we wouldn't have a great need for welfare if you had deflation, because it goes back to my McDonald's example, right? The reason, one of the main reasons we have to have social welfare, and I realize there's always going to be people that need a social safety net. That's a completely different argument. So I'm not saying it totally eradicates poverty. Mm-hmm. I'm saying that the on aggregate total, the amount of poverty in the United States would go way, way down. I think you'd have a lot fewer households that would require a two income or a couple incomes to get by.
Right.
So I think if one of the partners, whether it's the guy or the girl, wants to stay home and raise the kid instead of sending them off to latchkey or have some random stranger bring up your kids, we would have more of those types of options. It just, I could go on and on and on, but I think it's just highly beneficial.
It makes a lot of sense. You laid out in a really eloquent way. One thing you mentioned is the the housing bubble, the state of the housing markets, and it's not something that we've touched on quite yet. And I feel it's such a foundational part of our economy and what's happening in the world right now, and it's definitely in your wheelhouse. So whether it's just in the United States or globally, could you touch on what's happening in the housing markets right now and what you anticipate to see unfold over the course of the next year or two, potentially even further?
Yeah, well, housing is part of the everything bubble, and it's not all housing. You got to real estate's very local, as we all know. So I mean, it's street by street. It's just, you can't compare a $15 million condo in New York to $100,000 single family 3-bed 2-bath in Cleveland, Ohio.
Right.
It's much different. So what I'm saying right now, as far as real estate, is I like shelter, but I don't really like real estate. So what I mean by that is if you've got a property that supplies the basics, just a very basic apartment complex, or a very basic single family home, I think your downside there is quite a bit less than if you've got something where there's anything that's in addition to just a roof over your head. So you throw in marble, Italian marble, or Sub-Zero appliances, a 10,000 square foot mansion, 10 acres, or a multi-million-dollar condo in LA or Vancouver or Toronto, something like that. I think that would be in addition to the roof. So I think that the part of your property that isn't shelter is going to potentially go down in value, where the part of your property with that's just shelter will most likely maintain most of it, but it could definitely still go down. So it's just asking yourself the question, with an investment property I have, what percentage of it is allocated to a shelter, and what percentage of it is allocated to something else? So, but the whole entire world, with the exception of a few places, the developed world, is in a massive housing bubble, because we've had 0% interest rates or negative interest rates in some places, and even some negative interest rate mortgages. So you can't have that and say that prices are somehow stable. I think what most people need to realize is that an interest rate is simply the price of money. And if you think about it, money is 1/2 of every single transaction. So if the Fed is manipulating interest rates, they're manipulating the price of everything, literally everything. You don't know what the value of a can of Coca-Cola is. You don't really know what the value of that share is, or that bond, or that house, or that car, or whatever you have. We really can't tell the value. It's like Jim Grant always says, we're living in this kind of hall of mirrors, where there's no price discovery. Everything's manipulated by the Fed, because they've got that interest rate supposedly under control, and they're doing so much quantitative easing that it makes it very difficult to make decisions. Now, that said, with the real estate market, I am bearish. I would not be buying right now, because my philosophy is you just buy things when they're cheap and sell them when they're expensive. And there's nothing cheap right now about most real estate. Back about 2 months ago, you could find a property here and there where you could get some good cash flow and use like the 30-year fixed rate mortgage at 3% interest to your advantage. But you're really not buying it for the real estate. You're buying it to take advantage of the cheap debt and the cash flow. But I don't want to go off on a tangent there. So you've got the market, let's say, that's inflated, and you don't have to take my word on it. Just pull up a chart of U.S. housing prices going back to 1900 adjusted for inflation. It's pretty much a straight line, which makes sense. Housing normally stays consistent with inflation because it's all about wages, and that's going to stay pretty consistent with inflation as well. So, and then in the early 2000s, you see this historic trend line that's pretty much flat. I mean, for 100 years, from 1900 all the way to 2000, when you adjust for the size of the home as well.
Right.
And then in 2001, 2, 3, you see it just straight up. I mean, vertical hockey stick. It looks like the Fed's balance sheet right now. And then, so it peaks out at 2006, and of course it comes crashing all the way down. Well, where does it bottom out in 2012? It bottoms out right on its historic trend line. Shocker, right? And then, of course, since then, it's gone back up to where in a lot of markets, it's exceeded the levels where it was in 2006. So I don't think any one of your viewers would suggest that in 2006, we were not in a housing bubble.
Right.
So assuming that 100% of the people watching this would agree that we were in a housing bubble then, well, then how are we not in a housing bubble now? If prices are just as high, but incomes really haven't gone up. It's, if you look at the price to income ratio, it's very similar, if not worse, in a lot of these markets. So, but I want to make sure people understand what I'm saying. I'm by no means implying that the real estate market is going to crash by 50% in the next 2 months or the next 6 months. That's generally not the way real estate works. It's like a giant ship. It takes a long time for it to turn around and go a different direction. Why? Because you have all these sellers that looked at the comps 2 months ago when they put their property on the market, and they're expecting to get that dollar amount, right? And then you have all these buyers that are looking at what's going on with the coronavirus and saying, hell no, I'm not paying 2 months ago prices. There's no way. So you've got this big delta, and it takes a long time for those to usually meet. And I did a video on this the other day where we had, of course, the housing crash start in, call it 2008, 2009, whatever it was, but that didn't bottom out until 2012. took 3 years. And I would also argue that now these bubbles are so much bigger and so much more detrimental, potentially detrimental to the economy, that the Fed is going to come in and they are going to bail out everyone. I mean, if you haven't been following the US news, they came out with a $2 trillion stimulus package.
Right.
And that gives people the opportunity, if they have a Fannie and Freddie loan, to not make payments for 6 months, and then you can extend it potentially to 1 year. And Fannie and Freddie loans are basically, I think, maybe 70% of the market. So, and that's not to say that you don't have to pay them. They just kind of, they delay the payments. So after that time, supposedly you'll have to pay, but who knows? You might not. So I think the Fed's going to come and try to backstop everything. And think about this. What happens to a mortgage? And it might, I'm sure it's probably different in Canada, but here in the United States, our mortgages are subsidized by the government in the form of Fannie and Freddie. There is no way anywhere that's not subsidized by the government you could get a 30-year fixed rate loan. No bank is going to keep that on their books because that's going to lose money all day long. So we just do it because we've got Fannie Freddie. So the bank, call it Wells Fargo, they do the loan with you, the home buyer, before the ink is dry. They're selling that to Fannie and Freddie, and they're bundling it up and they're into a mortgage-backed security, and they're selling it off into the market, right? So so the Fed, it's actually quite easy for them to get, call it 50-60% of the mortgages in the United States onto their balance sheet. Right, in the form of these mortgage-backed securities. So if the Fed owns, let's say, 60% of the mortgages in the United States, they're not going to foreclose on everyone. No way. They're going to sit there. No, don't even make your payments. No, we're good. Yeah, I mean, they're not going to obviously come out and say that, but they're going to somehow create that scenario. Well, we're doing this for the new homeowner act or whatever, that we're going to, Trump's going to come out, or whomever is going to say, we're going to have a special task force for housing to keep the homeowners in their homes. And they're going to come out with this program and that program. Basically, all they're doing is just extending and pretending, because they can, because those assets, again, are on the Fed's balance sheet, and they're not on the balance sheet of the private sector. Where would they otherwise be? Normally, that would be in like a pension fund, right? So if the homeowners don't make their mortgage payments, then the pension fund is screwed, because they're not getting that cash flow. Those loans default, and then the pension fund blows up, and then California can't pay their workers, right? But if the Fed is buying all those mortgage-backed securities at 100 cents on the dollar, so the pension fund is made whole, and then they can not foreclose. So my point is, there's a lot of tricks they can pull that have nothing to do with the free market whatsoever, to really prevent a type of housing situation like we had in 2008. So what I think is more likely is for housing to go back down to its historic mean. Remember, I was talking about that chart where, it's a very flat line, and where prices bottomed out in real terms, remember, not nominal terms. If you look at a nominal chart, the bottoms are always lower. That's all the housing bulls that you see on YouTube and all these, these real estate gurus and whatnot. They'll only look at nominal charts because it's very convenient for them, because the lows are always higher, right? But if you look at a inflation adjusted, going back to 2012, right? So, and I'll just do some quick numbers with you so maybe your viewers can understand how this would work. And I did this with my sister, because she lives in Dallas, Texas, and she's very bearish as well, but she's like, okay, well, thank goodness, because I think there's a lot of tailwind for the Texas real estate market, which there may well be. And I said, but yeah, Lise, you got to look at it in terms of inflation adjusted purchasing power, right? So let's just say you've got $100,000 house right now in Texas. And I said, and I was talking to my sister, and I said, listen, do you think it's realistic for the housing market in Texas to go down by just 5% for the next 10 years, or excuse me, for the next 2 years, just 5% per year for 2 years? And she said, yeah, I think that's probably realistic. I said, and then let's say it goes 5 years and just flattens out. to where prices aren't going up, they're not going down. And then let's say for the next 8 years, so we're looking at a 15-year cycle, right? For the next 8 years, it goes up by, call it 3 to 5% per year, the real estate market. I said, do you think that's realistic? She says, yeah, absolutely. I said, okay, well, do you also think it's realistic that from this year moving forward for the next 15 years, the US could experience 5% inflation per year? And she says, yeah, I think that's, especially with as much money as the Fed is printing, and I think that's very realistic. I said, okay, if you work those numbers at the end of 15 years, your house is worth half of what it is right now. That takes us down to that point on the trend line where we were in 2012, even though the nominal value of your home might be higher than it is today.
I think that's a big illusion that most people don't really take the extra effort to really realize is the dollar value went up, but adjusted to inflation, like you say, it could be half or back to the nominal rate.
Yeah, you just got to ask yourself, how much stuff can my house buy?
Yeah.
And if your house can buy half as much stuff in 15 years, does it matter what the price is?
For sure. It's a good point. So housing, probably not the most recommended thing to be getting into, like you said, especially if there's extra bells and whistles on top. You know, the base thing, like just kind of the bare bones, maybe at least more so of a store value for right now. You mentioned something also called stagflation investing. So could you maybe go over like what you feel would be something relevant for people to, you know, keep their wealth or potentially accrue some? And most of the wealth can be accrued during these bear markets because the
Yeah.
crashes happen so quick. So it's a really good opportunity. So yeah, maybe if you could just add a little bit of color to that.
Sure. The easiest thing people can do is just make sure that, well, in the United States, is to have a 30-year fixed rate mortgage. That's the easiest thing the average Joe can do. So although I would be, let's look at the last scenario we went through. Although in that situation, you'd be losing 50% of the purchasing power of your home, that didn't include the debt, because the debt, assuming that you can get an interest rate at, let's say 3% or 4%, but inflation is running at 5%, that means you're going to be paying back that loan in cheaper dollars. That is a transfer of wealth from the lender to the borrower. Okay, so you'd have to take that into consideration. Yes, you might lose some purchasing power on the value of your home, but you'd be gaining some purchasing power, assuming you had that fixed rate debt and inflation exceeded the interest rate on the debt. So that's number one. That's the easiest thing that anyone can do, is if you can get a fixed rate 30-year, if you've got whatever your loan is right now, if you can change it to that, that would be my best advice first and foremost. Number two would be, I think you got to own some gold or Bitcoin. I see them, I like them both, but for much, much different reasons. I don't really understand this whole Bitcoin versus gold debate. I think, to me, it's like debating whether oranges are better or Ford pickup trucks, right? It's not even apples and oranges. It's like, they're so different. The way I see it in my portfolio is I allocate a certain portion to insurance. That's about 10% of my portfolio. I also allocate about 10% to speculation. How I define that would be, I'm buying something just because I think the price will go up. That's it. And there's some asymmetry there. I think it may be cheap for XYZ reason. 80% of my portfolio that I would consider an investment is something that has to pay me to own it. It's got to pay me. So that would be like a very simple rental property that pays me to own it. I would consider that an investment. I wouldn't consider it insurance, wouldn't consider it speculation. So my point is, for me, the only thing that's really insurance is physical gold. It's just, I'm not trying to, like my buddy Eric Townsend says, you don't buy physical gold to get rich. You buy it to stay rich. It's just, that's your hedge. That's your car insurance, so to speak. You look at Bitcoin. I do not think it's insurance. I think it may be a risk-off asset. I don't know. We'll see. It's only been around for, call it 10, 12 years. I hope that it is. From a philosophical standpoint, I hope Bitcoin is the new US dollar. Like, I hope the whole world, that's the world reserve currency would be Bitcoin. That would be my dream, right? Now, I don't know that that's going to happen. I think it could, but the probabilities right now might be low because I don't think the governments would go for that. I think we'll probably go into a government-backed digital currency before we go there. But with Bitcoin, I think your asymmetry is extremely interesting. So right now, your downside, and I haven't looked at the price in a few days, but let's just say your downside's, it's at 6,000. Let's say your downside is $5,000, right? But your upside, even though it might not be a high probability, your upside is $1 million. Mm-hmm. So that's a lot of asymmetry right there. And I by no means suggest people have even 10% of their portfolio in, I don't, other than gold, I don't think you should have 10% of your portfolio in any one thing. I don't think you're diversified enough. But I think it's a very interesting, maybe 1 or 2%. And again, I'm not giving investment advice. I'm just telling you the way I see it, what I do for my own portfolio, and what I suggest to my friends and to my family members. And hopefully, you can take it for what it's worth.
No, I think there's a lot of relevance there. Like you say, let's say it's a 50-50 shot of it going to 0 or $1 million, and let's just say it's black and white.
That's a great bet.
Yeah, exactly. You're going to roll those dice every time. Yeah.
That's right. That's right. You're just not going to do it with your entire portfolio.
Exactly, because you lose it once. There you go. So pivoting back briefly to the coronavirus, just before we start to wrap this up, if we get a vaccine out, let's say tomorrow, boom, vaccine's created, it's tested, we roll this out, mass production, mass distribution. I know some people are against vaccines, but let's say everyone gets it. What's going to happen to the world economy? You mentioned coronavirus was the pin that pricked, I guess, really the big problem underlying. So are we going to go back to business as usual? I know business as usual isn't the best business. What would you anticipate to happen? It's a totally theoretical question.
I don't think you go back to where we were 2 months ago. I don't think the stock market's going back to, call it 30,000, something like that. Mm-hmm. I think it takes a long time let's look at the job numbers today, or the jobless claims, 3.3 million last week, 6.6 million today.
Oh, I didn't hear that new one. Wow.
6.6, man.
So that's now half the amount of the Great Depression.
You got 10 million jobless claims in the last 2 weeks. And from a lot of people that I go back and forth with on Twitter, a lot of macro guys, they're saying that could be low because the system is just backed up. Like, they can't process all the claims because so many people are making those requests. So what's the real number? I don't know. But in my opinion, you said if we get a vaccine in just a couple months. Okay. So assuming that, you're going to look at the unemployment rate going to, call it 15%, something like that. That's if we get it fast. Those jobs don't go right back. Mm-hmm. Another thing people really need to think about is how many businesses will actually exist in order for people to go back to. Mm-hmm. So even if this plays out just over 2 months, then a lot of restaurants, as an example, will be gone. They won't be there anymore. And so those jobs are completely gone until people are willing to come back in, invest the capital to build those restaurants again. Another thing is the way we got to where we were is through incredibly loose lending standards. When you get to, not just for the individual consumer, but when you get to the corporate level, right? These corporations were willing to, or were able to take on all this cheap debt. And I'm talking about groups that had no business taking on debt at a low interest rate. I mean, you look at WeWork.
Right.
You look at that. I mean, come on. You look at something like, I'm going to pick on SoftBank a little bit. Another one of their investments was a company called WAG. I don't know if you heard of WAG. but WAG was a dog walking app. Okay, pretty cool idea. All right, I'll give you that. But it's just simply you click the app and you find a guy or gal in your local area that's willing to walk your dog, and you pay them. Okay, cool. Fantastic. Let's remember all the apps like Uber and Lyft, they all lose massive amounts of money. I mean, massive amounts, right? But so SoftBank came in and gave them $300 million. $300 million, right? Not to buy the company, just to buy a little piece of it, right? So, and of course, now the company's worth maybe five. I mean, they've taken a massive haircut, but that doesn't exist unless you've got 0% interest rates and there's no other alternative for capital. And everyone, the pension funds, everyone with a dime to their name is as far out the risk curve as you can possibly go.
Yeah.
So let's just assume that gets dialed back in a little bit. In fact, quite a bit, to where people aren't willing to take those types of risk with their capital, because who knows, maybe a virus comes back. Maybe do you have immunity to it after the vaccine? Well, we kind of know, we don't know. And the unemployment rate is still high. What's going on between the United States and China? There are all these unknowns. You're going to have a long period of time where people don't want to put capital back to work. And if they do, they're going to require as safe an investment as possible. So just kind of what I'm calling on my videos is just food, energy, and shelter. That's really kind of, I think, what capital is going to focus on. So if you've got all these businesses, let's call it Uber, that lose billions and billions of dollars every single year, how do they stay afloat, right? I mean, hopefully they've got enough to last for the next 2 months. But you're going to have a lot of companies that don't have enough to last for 2 or 3 months. And so you're not going to have as many jobs, and those jobs are going to take a long time to come back into the system if they ever do, right? And so it's not just this boom, this V-shaped type of recovery. You've got a lot of pain to deal with, even if the Fed's able to paper over it and we get a vaccine, which obviously we can all pray for in the next month or two. And then the longer it goes, 6 months, a year, the worse that type of environment gets, and the longer it takes to come back to where we were as far as even getting unemployment down to its historic norm, call it 5 or 6%.
Yeah, no, that's exactly it. Because so many small businesses in particular, you don't have more than 2 weeks of runway, let alone 2, 4, 6 months. And they're just absolutely getting slammed right now, it seems. And a lot of this stimulus package, I believe there was like a total of 6 trillion. Obviously, I think a lot, like the 4 trillion was going to loans. But it feels to me like there's been a lot more precedent put on helping the big businesses out, which goes alongside this is a system that helps improve the 1% and not so much the common folk.
Yeah, and it goes back to the Fed, and it goes back to inflation. They have to have the asset bubbles continue to rise because they've built an economy that's completely dependent upon those asset bubbles. And if you look at consumer spending as 70% of GDP, and you look at the largest group of the United States as far as the demographic, I would assume that would be the baby boomers. And if they're all depending on their 401k for their purchasing power for the rest of their lives, well, what happens when that 401k takes a 50% haircut? What does that do to spending for the largest group of people in the United States? And then what does that do to the economy if 70% of it is just consumer spending? I mean, we go back, and it's easy to listen to the stories of these businesses saying, we've got to have funding, we've got to have this. But yeah, let's go back a little ways, right? Let's just assume that we had a priority that was put on savings, going back to our deflation type situation, right? So if all these businesses and corporations had, let's say, 6 months of a safety blanket, right? Or 6 months of an emergency fund. Just let's use consumer language. And if the consumer, I mean, the average savings rate in Japan is almost 30%. 30%. That's for individuals. So if we had that type of environment where savings is actually incentivized, not only at a consumer level, but a corporate level, and let's say you do have a coronavirus come in for 3 or 4 months. Okay, well, yes, that would be bad and you would have some job losses, but nowhere near what we're experiencing now, because you've got an economy that has savings. It's built on a strong foundation, and it's not levered up to the hilt to where it's built on this foundation of sand that just a stiff breeze comes by and it all comes crashing in on itself.
Right. Yeah. Well, this has been an incredibly strong conversation. Your points are incredibly valuable and insightful. So I thank you a ton for coming on to the show today.
Sure.
If somebody wanted to, find out more, okay, I want to find a little bit more about George Gammon, what he's up to, what would you say would be, maybe your flagship video to direct them to on YouTube, what they should search to be like, okay, this is a good starting point to kind of get a little bit more into depth on what I'm talking about and who I am?
Boy, that's a good question.
Or maybe just the most recent one. Yeah.
Yeah. Well, the most recent one I did was last night. Actually, yeah, go to that one. But keep in mind that we're all under quarantine right now. And usually my most popular videos are the whiteboard videos where I'm standing in front of a whiteboard. And now we can't do those because everyone's on lockdown. So I just have to take a picture of the whiteboard, give it to my editor, and then I have to kind of do like a play-by-play of the whiteboard. So if you look at a recent video, they've been wildly popular. I've done a lot of stuff on the Fed, a lot of stuff that's really applicable to what's going on in the economy right now. That's where your viewers will probably get most value. But just do keep in mind that that's kind of a makeshift whiteboard video.
Right.
And if you want to see a real whiteboard video, you got to go back 2 or 3 weeks and click on one of those. But it's just the YouTube channel's my name, George, typical spelling, last name Gammon. You can follow me on YouTube, check the videos, or just same just my name on Twitter as well. Those are the easiest places to find me.
Love it. Well, I'd say even without a whiteboard for this conversation, I think a ton of people are going to pull a plethora amount of value on it. So George, thanks again for coming on, and to everybody tuning in. See you guys next time.
Yeah, thank you.